It's so interesting to me how the brain tidies up everything when it looks at it in hindsight. It can speed up a year or 2 years, or it can speed up 3 years and go, well, yeah, yeah, of course that's what happened. But while you're in it, those years or those quarters or months or weeks or days, they feel really long. And this was the experience when I first had Bowen, when we had our first child. I mean, same thing with Ever, but the hours felt really long. I stopped working on Fridays when Bowen was born so I could get to know him and be with him. And I just remember that that first Friday that I was with Bowen alone for 8 or 9 hours felt like about 50 hours long, because kids are so present and they're so in the moment, and well, adults aren't. So it's hard to stay in the moment, and it's hard to kind of wait. And the markets are in a very interesting place now because they are demanding our human brain to do something that it doesn't want to do. And I have three charts to show you just why perhaps the last 2 years has felt more painful than it probably should. Hey everybody, this is RC Peck, and this is my 325th episode. It's great to have you here. And the theme the theme for this podcast is, huh? I guess I could have put Scooby-Doo there for everyone who knows Scooby-Doo and knows the noise or sound that Scooby-Doo makes. But I thought it was more fun to have Janet Yellen here with kind of like the, I don't know. So there's some weird things going on, and I think someone should write an open letter to Janet Yellen and tell her just to be honest about what she's actually watching. And I have three price charts I want to show you, and there are three. They're important all for different reasons, but let me show you the first one now. And the first one is the S&P 500. And the S&P has been in a sideways channel, a 15% sideways channel for 2 years. Now, to me, at least, in my open letter to Janet, I'd say, look, just come out and say, if the S&P 500 breaks out of its channel, breaks above this 2140 and moves to the upside, I'm going to start raising rates. And I'll raise them 0.25% every quarter. But if the S&P breaks below this line, and let's call that line the 1850 line, if it breaks below that, I'm going to lower the federal funds rate, or the target rate. I'm going to lower it 0.25%. And if it keeps falling, I'm going to lower it another 0.25% to 0. And if it keeps falling, let's say it gets down to that 1575 range, which is really down right about here, where in 2007 the market peaked, and in 2000 the market peaked. And just say, look, I'll take rates negative if it goes that low. At least then we'd be like, okay, we know what's going to happen. Now market, just do what it's supposed to do. Janet Yellen has told us that if the market goes higher, she's going to increase interest rates. And if the market breaks down below, she's going to lower them and go into negative. At least now we wouldn't be waiting on bated breath on what a handful of academics are going to do to the federal funds rate. And at least now there'd be transparency and clarity. But clearly right now, the market needs some stuff to go up. And even though Janet said they're not going to raise interest rates, and Mario Draghi is going to print €1 trillion and is going to take rates even more negative in Europe, which, by the way, if I were to, and I don't, but I've done it before, pulled up a price chart of the European community stock market, you would see that the previous $800 billion worth of money printing did not help Europe's stock market at all. And I do believe that Mario Draghi and Janet Yellen and Kurudo over in Japan and the powers in the central government of China, they are all looking at their own stock markets to figure out what they should do with their own rates. So until this breaks out to the upside, I'm going to say we will not have an increased rates for the federal funds rate. And I'm also going to say that until it breaks down, I don't know that it will, but if it breaks down, that will be the first sign that Janet will actually lower interest rates. But until then, guys, we are stuck in this channel. There's nothing much to do. The 200-day moving average is moving lower throughout this channel. So as far as a kind of a long-term trend, the trend is heading lower. Okay, the second price chart I want to show you, the second of three, is just the price chart of the US dollar. Now this is a zoomed out view of the US dollar, almost 5 years worth. And just notice here that we've been in this channel. Now this is about a 7% channel for the dollar. And this is a weekly chart, so I have eliminated all kind of intraday and intra-week and just shown you where the price of the US dollar has closed at the end of the week. And when my brain looks at this channel, it just looks like something's going sideways, trying to decide which way to go. These lows are getting a little bit higher, but I'm not sure if that really means much. And I wanted to zoom out because I also wanted to show you how the dollar was in a sideways channel for 3 years. So, you know, the US dollar can stay in a channel for a long period of time and it feels very drawn out. But eventually when it makes its move, and in this case back in 12, 13, and 14, the dollar moved out into the upside, and that continued to push gold down. And as it moved this up, oil took a huge crash. Oil actually peaked right about here in June of 2014. So when the dollar moves, commodities take note, which makes me believe that commodities have been falling for a very hard 4 years, that if the dollar did decide to break down, interest rates would lower in this country and commodities would go up, and maybe Yellen would get her gift of higher interest rates, or at least inflation, as commodities start moving up after 4 years. So we have the US dollar going sideways, and we have the stock market going sideways in the United States. Until one of those two things changes, we're not going to get much movement in either market or many markets around the world. Now, I say that with showing you this last price chart, which is a price chart of 7 to 10 year long duration bonds, U.S. bonds. So these are bonds that have the duration of 7 to 10 years. And if you look at this price chart over the last 2 years, you can clearly see, your brain can clearly see that the price is going higher for these midterm bonds. Now, not a huge amount. Way back here when this trend started, or at least where I'm showing you this kind of upward trend, the price was 99, and here it's 108. So we're looking at about 9% increase, but this is a bond. The point is that the price is moving higher. When a price moves higher, that means more people want to buy it, and that's exactly what we have with the 7 to 10 year US bonds. And that also tells me that as the US dollar and the US stock market, or at least the S&P 500, has moved sideways, over that time period, people have been saying with their collective consciousness, I'm gonna get a little bit more in these kind of mid-tier bonds, just in case. Let me set a little bit more money aside in there just in case, because I don't like this instability that I'm seeing out in the world, and I'm just gonna set some money aside. That's what someone would say. Of course, you can never actually set money aside. Money is always invested somewhere at all times. Just look at last week's podcast. So it's interesting, as the stock market's in a 15% 2-year long channel, and the US dollar is in a 15-month 7% channel, midterm bonds are going higher. So what is the takeaway? Well, we're kind of almost there, but I don't really know if we're almost there, because as I showed you with the dollar, this could go on a little bit longer. But here's the thing. If the dollar does break down, there is a very high probability that all things physical will go up. Gold, silver, commodities, real estate, because the dollar falling is going to move those physical assets higher, which will create inflation. So that's one thing we want to look for, and that's going to really change how people construct their portfolios going forward. And the other thing which I talked about, if stocks do move down, then rates are going to move down too. That's just my feel to Janet Yellen, and that would be in my open letter to tell her, like, just tell everyone, look, if stocks break down below this channel, I'm going to lower rates all the way down to this, and I'm going to raise rates if they go above here. Because the only two mandates of the central bank is price stability and full employment. Now, Of course, I do know what it means to have price stability. Janet Yellen says it's 2%. We don't have 2%. Maybe we have 1 and a change percent. But from a statistics point of view, on the unemployment rate that they certainly show everyone, we are at or very near full unemployment. Now, it may not be the unemployment that people want and the rates or the hourly rates they're getting, but from that one data point, we are at or very near full employment. And then the last is the longer we're in a channel, the longer the U.S. stock market or the S&P 500 is in that 15% sideways channel, the more explosive it will be when it moves out of it. And it will be an explosive move out, whether it's a move higher, because there will be more negative interest rates and more money printing by Europe or Japan, but something like that has to move it higher. The market is not going to move higher on its own. It does not want to move higher on its own. It actually wants to break out to the downside and start to recover from 16 years of really high, overvalued. It wants to work off all that overvaluedness that happened in the first decade of this century. And the only reason why the stock market will break above that 2140-ish mark on the S&P is because 1 of 4 people are doing something even more drastic. Those being the 4 largest people who, the 4 largest central banks and the people who lead them. And same thing with the dollar. The longer the dollar goes sideways, when it breaks out, it will move and make a large move, just like it did in 12, 13, and 14 when it finally broke out. Oil fell about 70%, and commodities got slammed even more. So we are kind of in a waiting place right now. Hey guys, this is just another step in helping you protect your portfolio and help you secure your future even more. Until next time, this is RC Peck.